Welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. On today's show, housing hurdles. Mortgage rates are coming down, but maybe not fast enough for many people. An expert will bring you the tips and the tricks to pay down your mortgage. And pain at the pump. We're tracking gas prices ahead of a busy summer travel season, so listen up there. Plus, money in the bank, or as T-Pain would say, money in the bank, will bring you the investment strategies to deal with what one financial advisor calls a global savings crisis. All that and much more, and plus more singing during today's show. But let's kick things off with a check of the markets. Stocks higher after the Dow pushed about 40,000 and hit 40,000 in intraday trading, but it failed to close at that milestone figure on Thursday. Here, you're taking a look at the Dow right now, just below that. Right now, we're flat, but just barely to the upside by about 0.09% here. The S&P 500 flat, but barely to the upside, as well as the NASDAQ there on a percentage basis flat. So we will see how we continue to navigate today's trading activity this Friday. We are just days away, though, from one of the most anticipated earnings reports of the season. Wall Street's darling, NVIDIA, will be reporting its Q1 report on Wednesday. And to break down NVIDIA's meteoric rise and what to look for in this earnings report, we've got Yahoo Finance's very own Julie Hyman here in studio with us. Hey, Julie.
Hey, Brad. There'll be no singing from me, but I look forward to more from you. I just want to set up a little bit first why NVIDIA is so important. Remember, this is a chip-making giant. It makes so-called GPU graphics processing units that have become really integral to this explosion in generative AI and the data processing that is needed to train AI models and then power them as they operate. This has meant that NVIDIA has really climbed in importance in weighting in the S&P 500. It is now the third largest company by market weight in market cap in that index, and it's a market weighted index. So the third biggest stock in the S&P 500 behind Microsoft and Apple. NVIDIA now $2.3 trillion in market value. You see here Alphabet and Amazon are even smaller when you look at that market cap weighting. And how did it get here? Well, if you look at the charts for the company here is take a look at the NASDAQ 100 year to date of the various stocks. And NVIDIA, if you look at the year to date chart for this company, it's up almost 90%. This is after it's 240% climb last year. So it just keeps going up and up and up. That means that it's gotten to that market cap level where it is today. And to look at it another way here, the market cap over time, which has just sort of exploded in the past few years. It's exploded alongside the revenue growth for the company. Going to back up just a bit to see if we can find that revenue chart. There is that revenue chart here. So you see the enormous growth that we have had in that revenue over the past few years in the triple digits after sort of hovering at the same level for 21, 22. What is so extraordinary about this, to just put a fine point on it, is companies, when they get this large, it is very rare, if not unprecedented, for them to grow at this level. To just give one example here, John Vinn over at KeyBank expects that data center revenue alone for NVIDIA will reach $200 billion in calendar 2025. That will be a 321% gain from 2023. So a more than 300% gain in just 2 years to $200 billion. Just to sort of compare it to what we have seen from other companies, usually companies that grow at that rate in terms of sales are very young companies. Tesla, for example, back in 2013, it grew revenue by 387%, but its revenue was just over $2 billion. Compare that again with just the data center revenue of $200 billion expected for this company. Just a few years ago, yes, NVIDIA was known for AI, but it was mostly known for graphics chips for video games and also for crypto miners. And in fact, it was the company of the year back in 2016 here at Yahoo Finance. I wasn't even aware of that. I wasn't here in 2016. And, back in 2016, here's the revenue right around there. So it's pretty fascinating how much it has grown, even as it is so large. Brad, it's been a fascinating story.
It absolutely is, and it's become even more fascinating, going to become even more fascinating next week. So what can we actually expect from the earnings report for this quarter?
So if we take a look at what analysts are expecting for earnings, they're expecting a lot of really incredible growth here. So $5.54 in adjusted earnings per share, $24.6 billion in revenue. Again, most of that is going to be data center. And many of the analysts had said there was some concern that there would be a sort of pause in demand for NVIDIA's chips. It's now selling its Hopper suite of AI chips, but it's introducing an even more advanced suite of chips and software later this year called Blackwell. There were some questions. Would customers hold off on their orders for Hopper chips while they're waiting for the Blackwell? And most of the analyst commentary I've seen has said, no, they will not, because they'll be concerned that they can get their hands on the next generation of chips, so they'll keep the orders that they have. All of that said, with the stock up almost 90% this year, Brad, many of the analysts are questioning the further upside and pop it could get from this particular earnings report because expectations are so high. And of course, the focus is very much going to be on the forecast for the coming quarter and the second half of the year.
All right, their eyes were watching NVDA next week here. Julie, thanks so much for teeing up what we're going to all be keeping close tabs on next week. Plus, turning now to the state of the housing market. Mortgage rates decreased for the second consecutive week, but the 30-year fixed still holds above 7%, where it's hovered since mid-April. So what does this mean for new home buyers out there? Joining us now, we've got our very own Rebecca Chen. Hey, Rebecca, what do we know here, and what's the weight on some prospective buyers out there?
Hey, Brad, thanks so much. So this week we saw mortgage rate, like you said, getting closer to the 7%. It dropped to an average of 7.02 for the 30-year mortgage fixed rate. On the daily tracking, we actually saw mortgage rates drop even in the 6% range. So we are starting to wonder that if we are seeing a downward pattern for mortgage rate that everybody has been talking about since the beginning of the year. Aside from just tracking this mortgage rate and how it's whether it's heading up or down, we also been tracking how home buyers are reacting to these mortgage rates. And what we saw this week is that even though rates has been dropping for 2 weeks straight, there hasn't been that much home purchase application on the market right now. And what that's telling us is that home buyers are still not convinced or not motivated to come back to the market because financing cost is still too high for them. Just to put everything into context again, right now at around 7%, we are more than double the mortgage rate cost than 3 years ago. So what home buyers are paying today in terms of to their bank is a lot higher than they would be in 2021 when rates were around 3%. So definitely we are seeing a little bit more activity and a little bit more drop in the mortgage rate, but there just hasn't been enough of it to entice more buyers to come back to the market. And then I think what this really tells us is that first-time home buyers, or really any buyers, are highly sensitive to today's rate. And given that it's been very volatile, going up and down every single week, we are seeing that this has a huge correlation to what buyers can afford today.
And so with that in mind, Rebecca, and with also the caveat that this is largely hinging on the Fed and what they do in the coming months, when could we see rates coming down?
That is a million question right now, Brad. To be honest, nobody knows when mortgage rate is coming down. One expert even told me that mortgage rates are famously known for being hard to predict, and we can definitely see that right now because I feel like every week when we talk to experts, they think it's going to go one way, but it ends up going another. So it's hard to tell where it's going to come down, but what I can say is this. Given what has been happening with the Fed, with the inflation data and CPI, most experts are saying that rates will probably fall further from today into the 6 to 7% range for the remainder of 2024. What this means is we will see some kind of rate cut later on in the year, and that will bring mortgage rate down for home buyers. And I did kind of want to talk about a little bit about what everybody we've seen across different financial institutions. Fannie Mae, the NAR, Wells Fargo, all these financial institutions, they changed their forecast recently from the beginning of the year. And all of them upward revised their forecast on mortgage rates. And when I talk to them, they say it's because they just see inflation being so stubborn and the possibility of Fed cutting rate anytime soon is getting smaller and smaller. And that is why everybody is upward revising their mortgage rate today. And what this means for housing market. I think that's probably what all the home buyers are wondering right now. What can this mean if it's 6 to 7% and if rates are being cut later? Essentially, what it really means is that you could have, when this happens, you could have a smaller financing cost, but it probably won't do much to the housing price because we are still in a shortage. We still see a huge shortage of inventory supply on the housing market. And inventory shortage is what is driving prices the most right now. So all that being said, there's still a lot of uncertainty in the housing market, but we'll be tracking mortgage rate very closely every week.
All right, Rebecca, thanks so much. Teeing up this next conversation as well for us here. In high inflation, interest rates, it's a double whammy for your Fannie here. It's weighing on homeowners out there, and the delinquency rate for mortgage loans on 1 to 4 unit homes. That increased to 3.94% of all loans outstanding at the end of the first quarter of 2024. That is up 6 basis points from the fourth quarter of 2023 and up 38 points from a year ago. That's according to Mortgage Banker Association's National Delinquency Survey. So, in this economic environment, how should you go about paying off your mortgage? Joining me now is Michael Roberts, University of Pennsylvania, the Wharton School Professor of Finance. Great to have you here with us. First and foremost, I mean, there are some people out there that just say, if they have the means, should I just pay this entire thing off right now? And what are the pros and cons of doing that?
Well, great to be here with you, Brad. So it's really a question of whether or not it makes financial sense to pay off that mortgage. So there's some steps or a train of thought by which consumers can go through to determine whether or not they should use extra money to pay down that mortgage. Beginning with, is this my highest cost debt, right?
That's the great beginning point. I mean, there are a lot of people out there that are trying to think about the tips that they receive often for paying down a mortgage. What are some of your top tips for having a strategy for paying down the mortgage?
Okay, so let's try and just break it down real simply. First, what I would do is I'd rank my debt by cost, because we need to think about paying off a mortgage in a broader context. So think about all the debt you have, credit card, auto loan, student loan, as well as your mortgage, and rank it from high to low. So that's the first thing you need to do. The second thing you need to do is figure out, what can I earn safely on an after-tax basis in terms of investing? Because what we're really thinking about is we're taking every extra dollar and asking, should I use this to pay down debt or should I invest it? And if I can earn more investing it, and I should do that. So if I have a mortgage that's 3.5% that I got 4 or 5 years ago, and I can earn 5.5% on treasuries, I'm not so sure, even on an after-tax basis, it makes a lot of sense to be paying down that low-rate mortgage. On the other hand, it's 7% today. I'd try and get rid of that as quickly as possible. Again, after I take care of higher cost debt, namely credit cards, auto loans, and possibly student loans.
What if there are homeowners that are thinking about when the Fed starts cutting rates, if there's going to be the opportunity to refinance, and then they're looking at a different type of regular payments that they could be making to pay down their mortgage? Should people be waiting for that?
Brad, I just don't think consumers should get in the habit of trying to time interest rates any more than they should get in the habit of trying to time the stock market. Look, I mean, the Fed committed to 3 interest rate cuts this year just 6 months ago, and now that's coming under question. So I'm not sure it's in consumers' best interest to be strategizing about where future interest rates are going to be. Rather, just focus on that simple trade-off between where is my money best spent, paying off high interest rate debt or earning a higher rate of return. Again, assuming that that rate of return is safe, because you have to pay off your debt. The stock market doesn't have to pay you.
Certainly. Just lastly, while we have you here, how does age factor into the decision to pay off mortgage?
Yeah, so that's a great question, because once we get older, as I'm experiencing myself, right?
All of us are, Michael. It's inevitable.
I know, don't remind me. Once we lose that labor income, right, then debt becomes much more precarious. So trying to pay it down gradually over time and getting rid of it as we move into our retirement years is definitely a good strategy. The question is, how quickly do we want to pay it down? And remember, if you have all your wealth locked up in a house because you paid off your mortgage really quickly and you didn't save, that's very risky, right? All your wealth is tied up in a highly illiquid asset, a highly illiquid risky asset. And God forbid you have an emergency where you need some cash. It's very hard to extract money out of a house. Much easier out of some sort of liquid investment like bonds or stocks.
Michael Roberts, University of Pennsylvania, the Wharton School Professor of Finance. Great to have you here with us today. Thanks so much.
Thank you.
Certainly. Coming up, everyone, your gas, your wallet. We'll dive into what you can expect to pay at the pump this Memorial Day weekend upcoming and throughout the summer. Stay tuned. Let's do a quick check of the market sponsored by Tasty Trade. You're taking a look at them here, but we've got them blown up for you full screen now as we're taking a look at the Dow right now. It's about 100 points below that 40,000 marker, which we were able to touch intraday yesterday. Didn't quite close there. However, hey, there's still a fighting chance. There's always today and next week. And as time goes on, even more time. Anyway, Dow Jones Industrial Average flat, just barely to the upside. S&P 500 is also flat, barely to the upside. And the NASDAQ Composite. Stop me if I sound like a broken record. It's up 0.04% right now. Gas prices are expected to rise this summer by about 10 cents per gallon amid falling refinery capacity and higher refining costs. That's according to new data from the Energy Information Administration. So, what will this mean for drivers in the weeks and months ahead as we get into the busy summer travel season? Joining me now to discuss, good friend of the show, Patrick DeHaan, who is the Gas Buddy head of petroleum analysis. Great to see you, Patrick. We want to you specifically on this topic because people are trying to figure out, okay, what should we be expecting as we're hopping in the car, packing up the family, and getting ready to go to wherever we decide to go to get some R&R?
Well, thanks for having me back. And as you mentioned, the EIA recently revised upward its forecast for gas prices this summer. I would take the underside of this bet, however, the EIA predicting a jump of 10 cents to about $3.70 a gallon. I would point out, though, that we hit $3.69 about a month ago now. We've actually seen the national average fall 10 cents as we approach Memorial Day. Yes, Americans, it can happen. Gas prices coming down ahead of the holiday. I don't think we'll see an average of $3.70. I will point out, though, there certainly is risk in the month of August. A major hurricane certainly could impact prices. But for now, I'm expecting average gas prices this summer to stay probably in the mid $3 a gallon range. The exception, of course, the West Coast. California should see prices falling back below $5. But I think for the rest of us, it's going to be a eerily similar price at the pump this summer compared to what we saw last year.
You know, I know that you're not a climatologist, but you just mentioned something really interesting there, Patrick, which is, of course, the give and take or the relationship between the weather systems and gas demand as well. What are the anticipations there?
Well, it certainly could be a very busy one. At least that's what those forecasters tell us. Colorado State University and the National Weather Service both indicating it's going to be a very busy hurricane season because of El Nino conditions. In fact, Colorado State University puts the odds at about 40% of a major storm entering the Gulf of Mexico. Of course, that would be very bad news. Many of the nation's largest refineries, of course, not only hit by severe weather last night, but a lot of those lie between Houston and New Orleans in Louisiana and Texas. So any major storm going into the Gulf of Mexico certainly would be bad news. I would mention the peak of hurricane season. It does take a little bit of time for hurricane season to reach its peak. That usually happens in August. And that's why for the month of August, our projection is that we could either see prices lower in August if supplies continue to build, or we could see a brief blip if we do see a major hurricane. It is still possible that the national average could jump close to $4 in a worst case scenario.
When people are typically booking air travel, they're always told or frequently told, hey, yeah, book on Tuesdays because that's the time where you're going to get the most deals. It's not the same that you can apply to when to fill up the tank. But if there are tips or tricks that people can lean into to try and mitigate some of the costs at the pump, what could they be?
Yeah, there's a lot of those tips. Things like driving more fuel efficiently certainly can increase the amount of miles you get out of every tank. When you have to fill your tank, making sure you're getting the best deal. Apps like Gas Buddy, Google, or Waze will point you in those right directions. Being mindful of state lines for those traveling on longer road trips this summer. Those state lines are basically danger zones for gas prices. I just traveled down to Mississippi a couple of days ago. Traveling out of Illinois into Kentucky, you'll see gas prices basically fall 30 to 40 cents. Things like routing your trip, certainly using Google to map a more efficient route. There is a fuel efficiency route that they do have in their app. And when you pay for that gasoline too, after you find a good price station, checking out if there's a free loyalty program, things like fuel rewards. A lot of stations have those loyalty programs that roll back your price. So there's a lot of different ways. Nobody should be paying what that street sign says this summer.
And just lastly, while we have you here, Patrick, because there are a lot of the superstores that will have their own rewards programs as well with gas stations annexed. Is there one that's winning that battle versus others?
Well, certainly what some of the wholesale clubs stand out. Costco in particular, they do a real great job with an aggressively low gas price to get people to their location. But there's not really a whole lot of other standouts, right? Costco often has a very low everyday gas price, but even that has been shrinking a little bit in the last couple of years. I would say that there's a lot of loyalty programs out there from fuel rewards, BP, a lot of the major oil companies have fuel rewards. You mentioned the supermarkets as well. Kroger have loyalty programs. They team up with Shell, I believe, in some instances. I would just employ a lot of folks to go out there and make sure if you're buying groceries, there's certainly the opportunity, whether you have a loyalty program or a credit card that will give you rebates or rewards. There's a lot of ways out there to reduce what you're paying at the pump.
Patrick, always a pleasure to see you. Thanks so much for hopping on with us.
Thanks for having me.
Some valuable information for travelers out there. Patrick DeHaan, who's the Gas Buddy head of petroleum analysis. Great to see you. Coming up, everyone, our next guest says that we're in a global retirement and savings crisis. Yikes. But don't fear. We're going to bring you the strategies that you need to avoid the pitfalls. Coming up. When it comes to saving for retirement, Americans are feeling pretty pessimistic. An overwhelming 79% of Americans say that our nation is facing a retirement savings crisis, according to a survey conducted by the National Institute of Retirement Security. So, how can we defy this trend? And what are the strategies that you need to avoid the pitfalls? Here to weigh in, we've got Sue Crotty, who is the Segal Marco Advisors Chief Investment Officer. Great to have you here. So a lot of people are just trying to figure out why. Why are we in this retirement savings crisis right now? Are there some reasons that you've been able to summarize and point this back to?
Yeah, a couple, Brad. As everybody knows, we probably can't retire on Social Security alone. So we need some sort of way to save for retirement. The two most popular ways, obviously, being a defined benefit plan, or the more popular in terms of the numbers and the assets, the defined contribution world. Just a couple of stats. The lowest paid 25% of workers have access to a DB plan, about 8% of people, and to a DC plan, about 45%. Of which less than half of those will actually participate in the plan. And even if you go up to the highest 25% of people, its DB access is about 40 and much higher on the DC side, 70+%. But again, here only 63% of them will participate. So, the latest numbers I've seen from Mabry was, an average 40-year-old who has a DB or DC plan has about $38,000 saved for retirement. And the average across the entire population, which, 1.2 plus million people, is about $70,000. So that's not going to be enough for anyone in retirement to try to maintain their standards of living.
Certainly.
So what do we do about it is the real question.
Right. And that's part of the next question here. How do we get to a point where we begin to make meaningful improvements and claw our way out of the retirement savings crisis?
Some of it is in plan design, automatic enrollment, automatic escalation, those sorts of things. If you have access to a plan, certainly no, that is the way to build wealth. There are a lot of new proposals coming out in terms of creating access to retirement plans. Small businesses right now, which, employ, close to 50% of workers, 70+% of those don't have retirement plans. So that's an area where we really need to try to figure out solutions. The Secure Act did come up with some ways to help access and lower costs of offering some sort of retirement plan, but it's in its infancy and it really needs to be pushed in order to gain broader access across a larger population of our country.
For a lot of retirees or planned retirees, I mean, all of us plan to retire. So all of this considered, one of the major things that it was a part of the thought process for decades at this point was, hey, you're looking to retire, you go to a warm weather state, maybe you go to Florida or something like that, and you just kind of chill out down there on your retirement, on your Social Security. It seems like the equation is changing drastically, and are there other states that are also trying to make sure that they are making it more livable for retirees?
Yeah, as I mentioned, there's lots of different new plans that are being thrown about and discussed, and some being implemented. A lot of statewide plans are coming into effect at this point in order to try to enhance people to put some money away. And those vary state by state. And, I couldn't even start to go through the wide variety and amounts. And but it's, it's easily accessible if you just Google your state retirement government plan. That is one way. Roth IRAs are another way. And, part of the problem is that it's just not in the nature of many people these days to put that extra dollar away. It's why I started with saying retirement plans are the best way to try to build wealth. It compounds tax-free. It comes out when you're theoretically at a much lower income rate in retirement. So when you have to take money out, a defined benefit plan, which for a long time in this country was the single biggest and easiest way to put money away, is now just a very small fraction as DC has taken over it. For DC plans, making sure that you maximize a company match is a very important thing to think about.
Yeah.
I talk to my kids about this all the time. It's giving money away if you don't actually put in enough to get that company match.
Yeah.
So those are all ways you should be thinking about it as you look at, and it's never too early.
Absolutely.
Even if you put the minimum away, if it compounds over the next, you're 20-year-old, over the next 45 years, you're going to have a decent amount of money, and you won't miss that $2 out of your paycheck.
No, I haven't yet. Sue, thanks so much for taking the time here with us today. Sue Crotty, who is the Segal Marco Advisors Chief Investment Officer. Appreciate it.
Have a good one.
You too. Coming up, everyone, with credit card balances at an all-time high, could personal loans be an option for you? We're going to go over some of the pros and cons for those who are loan curious next. Wednesday's CPI report showed that while the pace of inflation may be moderating, consumers are still feeling the pressure on their wallets. One area that this is showing up in, credit card debt, where the average debt per borrower, $6,218. There you're seeing it on screen, up 8.5% from last year, 2023, according to TransUnion. For more on how consumers are dealing with their debt, we welcome in Dan McKeely, who is the Discover Personal Loans Vice President. Okay, so why is it that we're seeing credit card debt pile to this level here? What are some of the leading factors that you can point back to?
Yeah, Brad, thank you for having me. So you said it, inflation, I think, is the primary cause. Discover Personal Loans did a survey last year, and the top reason for consumers feeling stress was inflation, 58%. And as a result of that inflation, they're seeing higher prices in pretty much all areas of their life. And in some cases, they're using debt to finance it.
And so with that in mind, I mean, we're starting to get into the conversation now of, okay, if someone has this debt that is mounting up, where do they need to start thinking about loans in order to pay down some of that debt? And what should the evaluation be there?
Your earlier guest was talking about the different rates that they might have on different types of debt. I think the same applies here. Credit card average APRs in 2023 were at 23%. That is up from 16% during a period of the pandemic. And so by comparison, a personal loan could offer them the opportunity to refinance that debt as low as 6.99% if they have outstanding credit. So there's an opportunity for substantial savings if somebody has great credit and they can roll that higher cost debt into something with a lower fixed rate payment.
Is there a general rule of thumb for a percentage improvement that a person should be looking for when they are consolidating debt?
I don't know that there's a specific percentage improvement. One of the great things about a personal loan is that you can check your rate without impacting your credit report. So you can explore your options. And I think options are a consumer's best friend, especially somebody who's trying to manage their debt. So I would encourage somebody who thinks they might have a savings opportunity to go out and figure out what rates they can actually earn, explore their options for payments and rates.
Are there some tips as well that you've been able to kind of have in terms of the relationship between Discover Financial and its customers on how to pay down debt, but also where to stop spending maybe? Because that's part of the other equation, making sure that you're not racking it up on a continual basis.
Yeah, that's right. Everybody needs a budgeting strategy. The 50-30-20 rule, 50% towards needs, 30% towards wants, 20% towards savings is a very popular strategy. Also trying to increase incomes. But those are difficult things to do. And so making sure that you're getting the best price you can on your debt is something that sometimes people overlook. So what I would suggest is going out there, exploring all options, having a good strategy to manage the spending is, of course, top of mind. But going out and looking at any opportunities to refinance that at a lower rate.
Our producers probably hear me ask this all the time, and they're about ready to throw a stapler at the control room monitor when I say this, but we've seen the way that the consumer is described change so frequently and recently over the past year, from the consumer is resilient, then to the consumer is healthy, now to what we're hearing from some of the retail CFOs and C-suite saying that the consumer is relatively stable here. If the consumer is spending or tapping or swiping the credit card at this frequency, what does that tell us about the state of the consumer from the Discover perspective?
I think we saw earlier, as you mentioned, the Bureau of Labor Statistics Consumer Price Index is better than it was in prior months. But that's of little relief to consumers. So they're still seeing the effects of higher prices. That's what it tells us about the state of the consumer. Typically, they would prefer to avoid debt. I don't think that people are in a situation where they're managing debt should be ashamed of it. They need to be able to have that conversation open and honestly and try to get themselves out of it. There are some positives here. We know that 80% of customers who take a personal loan to consolidate debt report that they feel less stressed about their financial situation. So there are ways to manage their debt better and meet their overall financial goals.
Dan Nicoli, who is the Discover Personal Loans Vice President. Dan, thanks so much for taking the time here on this Friday.
Yeah, thank you, Brad.
Absolutely. It's a good practice to try and pay your credit card on time, but what happens if you don't? Joining me now in studio, we've got Yahoo Finance contributor Ross Mack. All right, in the event somebody does not pay their credit card on time, what should they expect to happen?
Well, one, I don't want to be a Debbie Downer, right? Listen, obviously we understand you want to pay your bills on time, but some people are carrying the balance, are actually failing to do that. And when it's all said and done, it's going to impact your credit score, right? At the end of the day, we're talking about what makes up your FICO score. Paying your bills on time is 35% of that. So literally missing one payment is going to have a significant impact on your score. It can go down about 100 points at max, right? But not only that, it's also going to stay on your credit report for up to 7 years. So now let's actually talk about what happens when your credit score is impacted, right? That's going to impact any other future credit worthiness when it comes to whether it's auto loans, home loans, personal loans. And guess what? What's even crazier? Some jobs are actually want to run your credit score.
Really?
Some jobs will literally run your credit score, and they might say, hey, if this person not paying their bills on time, guess what? They're probably not showing up to work on time, right? I probably can't actually, trust that person. And another thing is, right, financially, right? There are a lot of other ramifications, right? Obviously, higher interest rates you're going to pay when you try to borrow moving forward. But another thing, right? That interest rate is obviously going to compound. And so I saw, one of the stats that said the average, so like about half of Americans are carrying a balance right now, but the average is about $6,200. So using that number, right, you got to ask yourself, okay, what's the minimum? A lot of people get caught in the cycle of just paying that minimum. Oh, I'm gonna just keep paying the minimum. Guess what, people? The minimum is roughly 2% of what your outstanding balance is. So on that $6,200, I'll just round it to purely $6,200. The minimum at 2% is literally $124.
Yeah.
However, if you have an average interest rate on that credit card, that's roughly $124. So the reality is you would only be paying the interest rate and not the principal. So for instance, on that graphic that we just had, if it was actually to bump it up to maybe $130, you're paying $6 extra, well now that will actually get you to pay it off, but guess how long? 13 years, right? And now you're also paying a ton more in interest. I think you'd probably be paying over 5x what you borrowed. So it's a lot of ramifications when it comes to credit cards.
There's also been a new way, of course, and this has been revised, at least the way that the credit score is calculated in recent years, where people can now have other regular payments that they're making, say, for instance, on rent, on things that are even, I think I heard even down to your Netflix account, if you're paying on that can actually help your credit worthiness. How many people are tapping into things like that? Is it clear?
I'm not sure if the data there is clear, but I do understand that there are other ways that people are finding, ways to actually say, okay, how could I actually help this person when it comes to being more credit worthy? Because obviously some people don't have access, or, other communities are traditionally underbanked, so they don't actually have, when it comes to, because credit mix is another thing that comes to your FICO score. So it's like, what are some other ways? And obviously everyone, for the most part, is paying their rent on time.
Yeah, we certainly hope so. Ross Mack, thanks so much for taking the time here, joining us this week in studio. Appreciate it.
My man.
Absolutely. Coming up, many Gen Z professionals are not about that traditional life. We'll dig into the statistics backing Gen Z's preference for freelance careers. Gen Z, I don't hate you. I just want you to know that. It's in the prompter. Our producers wrote it. I'm going to read it here today, but we're going to dive into it a little bit on the other side. But before we get into that, NVIDIA reports quarterly results after the bell Wednesday. Here's a look back at the company's rise. We've all read the headlines. Gen Z has a different view on work than their older counterparts. More than half of Gen Z professionals are choosing freelance careers over traditional jobs, the headlines say. And the majority of them are choosing freelance for flexibility. That's according to Upwork's latest survey. So, to break down what you need to know about the Gen Z workforce and, of course, to demystify the headlines from the actual data, we've got Kelly Monahan, who is the Upwork Research Institute Managing Director, here with us. Kelly, great to see you. Thanks so much for taking the time here on Wealth. First, where ultimately are some of the Gen Zers kind of flocking into the workforce based on this survey data?
Yeah, Brad, what we see within our survey data is that Gen Z is really redefining what it means to have a long-term career today. As you mentioned, our headline is, over 50% are choosing to work full-time in a freelance capacity. And I think a lot of that is driven by the macroeconomic conditions, that they need to make money and that they want stability. And they've seen a lot within the macro climate today that's caused, whether that's been layoffs, inflation. And so this need to be much more in control of their careers is what I'm seeing underneath the data set. And where are they working? It's in really highly skilled avenues. So 70% year over year growth we've had on our platform in the areas of AI and machine learning. And these Gen Z freelancers are much more likely to already have the AI certificate in their hand ready to go.
No doubt, Gen Z will have had its hands on technology for far longer, at least in a percentage of their life, than generations prior, purely because for much of the technological advancements, they've been there literally since they were born, really. And so all of these things considered, what do business leaders need to know about how to engage with Gen Z in the workplace and how to, of course, continue to make sure that they are, for lack of a better word, stimulated at work?
Yeah, so I think this is a big wake-up call for leaders today. The way that we've structured employment and work, I think through often the times you hear, and HR leaders in particular talk about it in terms of talent acquisition. Meaning I want to find that one person, that one unicorn who can come in, and I don't want them working or doing anything else, but working on this role or this job. Gen Z is telling us that's not how they want to work. And so what they're asking business leaders to think about is talent access over talent acquisition. And that means I want to come in, I want to work on projects that I find meaningful, that I'm learning and developing and growing my skill sets on. They're the most diverse generation to ever walk the planet as well. And so they're looking for cultures and environments where they can feel they can be themselves, which is why we found 63% of Gen Zers are freelancing because of that reason. They don't feel they can be themselves in corporate cultures today. So if I'm an executive, I got to really be rethinking through, how do I access this talent? How do I make sure I don't need to have control ultimately over them? And I'm much more open-minded. They're going to be working in an open talent ecosystem today.
How does the wages compare? I mean, we're talking about a generation that is really cozied up to the idea of having flexibility, setting their own schedule, knowing the type of projects that they want to work on, and being able to really thrive in a freelance-driven environment more than ever before, perhaps, versus some of the wages, some of the coverage, even in benefits and total compensation packages that it would be compared against if it was just a normal 9 to 5.
Yeah. So I think the great thing that we're seeing with Gen Zers in particular on our platform is that they're able to set their own rates. And so I know there's obviously a lot of conversations around the social safety nets, but what Gen Z has been able to do, especially those that have a post-grad degree. So we saw within our survey research too, that 7% of Gen Zers who hold a post-grad degree are again choosing to freelance full-time instead of going to a corporate position. That's a really big flip than what I was expecting to see in the data. And I think what we've seen from other generations. So because of that, if you have Gen Z, if you've got the right skill set, especially those in the technical domain, and/or let's talk about enduring human skill sets too, those that can manage, communicate large complex projects, you actually might be able to earn more going through a freelancing route because you're able to set those wages and making sure that you're doing so in a way that covers your social safety nets.
Kelly, we only got 15 seconds left. And in a game, informal game of, so you think you want to freelance, what is the number one consideration that people need to keep in mind?
Number one thing is making sure that you're learning and reskilling. In order to freelance, you're in control of your career. Make sure you're staying on top of the trends and continuing to skill with what's in demand today.
Kelly, crushing it. Kelly Monahan, who is the Upwork Research Institute Managing Director. Thanks so much for the time.
Thanks, Brad.
Absolutely. Let's do a final check of the markets here as we're taking a look at the major averages. Oh no, slippage on aisle NASDAQ. We're flat, just barely to the downside. We'll see if we can hyper-oscillate as we go on throughout the rest of the day and ultimately end back in positive territory. Fingers crossed. Dow, S&P 500, they're in the green, just barely by the hair of a chinny chin chin. That's it for Wealth right now. I'm Brad Smith. Thanks so much for watching. And stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up 3 p.m. Eastern Time. You don't want to miss it.